Hello folks, and welcome to another episode of Financial QB TV, and I am your host Richard Reyes, the financial quarterback and investor coach, and this is the only place on the net where of course we care enough to tell you the truth. So today I want to continue to talking to you about retirement planning and the importance of refocusing on the importance of contributions, your portfolio, your process, and the benefits. Let's take a look at the formula again that I taught you in the first episode, which is C plus R plus W. Nothing, no rocket science here. Basically, it's contributions plus returns equals wealth. This simple formula is flexible, but you must always remember that there is a cause and effect to the W. The changes you make to the C and or the R truly affect their wealth either positively or negatively. Now today what I want to do is concentrate on the R portion of the formula. R again stands for returns, and returns are determined by what you select to invest in, whether it be stocks, bonds, or cash. Now, because of poor education on investments and because people are so often swayed by the news of the stock market and that it does and will go down, I am often asked, hey, quarterback, QB, do I have to have stocks in a portfolio? And you know what? The simple answer is no. Of course you don't. Of course you don't have to own stocks in your portfolio. You do not have to own equities. It doesn't make you dumb if you have a bad experience with equities and you're thinking about that you rather avoid the risk of equity ownership in the future. You can make a financial plan or a financial process work without owning equities. If you don't want to own equities, though, it just means that you should have a lower lifetime return assumption to your planning. But rate of return is just one assumption in your plan. You have other assumptions. You can either save more, you can retire later, you can spend less in retirement, you can, of course, leave less money to your kids, and last, of course, you can decide to die earlier. Well, the nice thing about these options is they are options that you, yes, you can control. You have no control over the return of your portfolio, especially if you own equities, but you can control how much you spend, when you will retire, you know, how much you plan to leave to your kids, so on and so forth. And making one of these adjustments can have a massive impact in the expected success of your plan. So please realize that financial planning is not about trying to talk yourself into putting all your money in stocks and then dealing with the pain of down markets. It is about deciding which options or benefits you can have in the future. So I appreciate you for tuning in to part number 2 of refocusing in your retirement, and I'll see you again next time for part 3. Thanks for tuning in to Financial QB TV.